let's walk through several notes receivable calculations, computations, applications, whatever you want to call them. All right. First one, let's look at if we assign or pledge some receivables. So let's do something with secured borrowings. Okay. So let's assume that we have, I don't know, we're looking at a $200,000 loan. And to secure that, we're going to put up $400,000 of our receivables. Okay. We're going to put those up as collateral. So some accounts receivables as collateral. You can do accounts or notes receivable. Okay. And we're going to continue to collect the receivables. So what is this? I'll give you a little pop quiz there. Is this an assignment or a pledge? Well, if we keep the receivables and collect them, then this is an assignment. So we are assigning receivables for this, so not pledging. So we're going to continue to collect these receivables, and with this assignment, the bank is going to assess us a finance charge of 2%. And this finance charge is 2% based on the receivables. Okay, so based on accounts receivable. And the interest on the loan, let's do a 10% interest. Okay, and this is realistic for the note, okay, for our notes receivable. So let's do our journal entry. Hang on, sorry, get my technology to work. Back. Okay. Ooh, there's a dot. Now I know it's back. Okay. So let's do our entry when we actually receive this note. Okay, or the loan itself. Okay. So we receive cash. Let's go ahead and write cash down. Let's not talk about how much quite it is yet. And we know there's going to be a note payable. So I always start with the easiest thing. How much is the note payable? How much are we borrowing? We're really borrowing $200,000, and that's what we're going to have to pay back. But we're doing an assignment here, and so we have this 2% finance charge. So it's like it's a discounted note, okay? So we need to discount the note. And it's 2% of what? It's not like a discounted off of this. It's 2% of the receivables that we're pledging. That's how much we're going to discount it down. So 2% of the $400,000 is $8,000. So we're not going to get $200,000. We're going to get $192,000. Have to take that $8,000 off there. So the $8,000 goes to interest expense. That's what happens when you have a discounted note. Okay? So there's the first entry. Now, the other entries, we're just going to, kind of rock along if you want to continue with it, but that's how you would record it. When you pay, make your payments, that's going to be the same as have before. If you get some of these receivables in, you're going to debit cash, you're going to credit accounts receivable. You can do that. Let's say we had, $200,000. Well, let's not use that. Let's say $150,000 was collected on receivables. Well, we got $150,000 in. I'm going to shortcut accounts receivable. Credit it. That's the same. We retained the receivables, so that doesn't look any different than normal. Okay, they don't go to the bank. The bank, doesn't collect them for us. We didn't pledge them, so that looks exactly as it should. And then when we get ready to pay this note back, okay, we've got notes payable. We're going to debit the face. Full principal of it. We're assuming this is an installment note. Okay. We're also going to have to calculate interest because that beginning interest was just based on our assignment of those receivables. It was not this 10% interest. It was this 2%. So 10% of the loan, okay, the loan's $200,000, and I don't think I gave you the term of the loan, which you might need to know to calculate. Let's assume that this is, I don't know. Let's do a 3-month loan. Okay, it's good for a short term. So let me write that up here. This was a 3-month term. Okay, so we got $200,000, 10%, 3 months. So you do this by 3/12, and so you should get $5,000 in interest expense. That means that we're going to pay back $205,000. Okay, there we go. So that's an assignment of receivables. Let's do an example of a recognition one. Let's say that it was a circumstance where we're trying to recognize a note that was in exchange for property, goods, or services, that category that we talked about. So let's get, there we go, clean piece of paper here. So let's assume that we've got two different transactions, okay? The first transaction, let's say we sold some land, so we're exchanging some land, okay? The fair value equals $700,000, and we're going to exchange this for a 4-year, 0 interest bearing note with face equal to 1 million. Oh, you know what? Let's change this. Come back. There we go. 101,460. And let's say that the land, let's go back up your sold land. The fair value was $700,000, but the land has a cost to us equal to $590. Okay, so there's the first situation, number one. All right, the second situation, well, no, let's just deal with that. Let's not confuse you. Okay, so we've got to figure out how to value this and how to make up our journal entry to record this transaction. Let's also say that both us and the customer in these transactions, we've got credit ratings that put us at a 12% interest for borrowing. Again, we don't have, it's a 0 interest phase. Okay, so let's look at all this and try to figure out what to record. Well, we know the face of the note, right? So I can go ahead and record note receivable. I know how much that's going to be. The face of the note is 101,460. Then that's how much we're going to record that for. Okay, so that's easy peasy. Also, I know that we're going to give up land. We're selling the land and we're getting a note. How much is the land recorded on our books? Well, we don't even need to worry about depreciation here because land is not depreciated. So the cost is $590. That needs to get taken off of our records. So we would credit land of $590. Well, we've got two pieces here. I don't really know the value of the note because it's 0 interest bearing, and I don't really know because I don't have a stated interest, 0 interest bearing, so I don't really know how to compare that to get a discount or premium. And then we have the land as well, and this is the cost. So we need to look at gain or loss on the sale of land, but we don't need to confuse the two because we could be dealing with a discount or premium here, we could be dealing with gain or loss here, or both. So for this one, we've got some information that'll help me with just this piece. I know that fair value of the land is $700,000. So if I compare that to our cost on our books, that'll tell me whether we're selling this for a gain or loss. And you should see that we have a gain on sale of land for $110,000. That's the difference between that $700 and the $590. So now all I need to deal with is, okay, what's left? So what are we talking about with the note receivable? If you add these two up, we haven't quite gotten to this one yet. In fact, we have a difference of $401,460. And this is going to represent the discount on the note. Oops, sorry. I'll shortcut that one. Remember, the discount will be opposite. We looked at bonds, discounts were debits, but now we're on the other side. Bonds were on the payable, we're on the receivable side. So we were talking about debts before, but now we're, still debt to someone, but to us it's a receivable, so we're talking about the asset side. So premiums would be the same as, discounts are the opposites. That's the discount. Now you can also calculate this. You can use that 12% and get a present value calculation of the note and see if that's $401,460 as well. Okay, I'll leave you to do that. Let's look at number 2, and we'll do a present value calculation on this one. Let's say that instead of the land, that you provided services. And in exchange for the services, you got a 3% 8-year note with face of $400,000 with semi-annual interest payments. Okay? So I can go ahead and start this one. Again, I know what notes receivable is going to be because I know the face. That's what we record that at. So we've got face value, $400,000. Now, I know I'm going to record service revenue, but I don't know what it is yet. So I'm just going to leave a space here. Service revenue. It's going to be something, and this something is going to be the present value of the note, whatever that is. Okay, so this is where we need to do a present value calculation. All right, I'm gonna test you a little bit. I can't be there to see if you actually do this, but based on our time value calculations that we've done before, you should know how to do this calculation. Okay, you need to go to your tables, or if you like the formula, you can use the formulas too, but you need to do present value calculation. Let me make a little box up here, make a little space. All right, so there's 2 things you should look for. First, you need to do present value of the face. The second thing you need to look for is present value of the interest payments. Okay, so the face value is $400,000. The interest payments are how much? You should know how to do this. Pause, calculate it, see if you get the right number. Maybe not. Okay. And I think, did I say these were semi-annually? You know what? Let's make it easier. Let's just do annually. We'll simplify it. Okay. So let's do annual. So that would be $12,000. That's what you should get. Okay. That's your interest payment each year. So now you need to go to the tables and look up the present value factor. Okay. We said that, now we listed 3%, right? But in the tables, we need to be using this 12%. Okay, that's what we're using as the market rate. So 12%, and it's 8 years. We're doing it annually. So you use that, and you go look up present value of a dollar, and you should get, if I've got mine right, 0.40388 as the factor here. And for the interest, remember, this is not just one lump sum. This is an annuity. Okay, so you go look this up. You should get 4.96764. Okay, for the number here. When you do that, you do the present values, you add them together, you should get a total amount of $221,163.68. The difference between these is the amount of the discount or the premium. In this case, it's a discount. Discount on notes receivable. I'll shortcut that one. And that is $178,836.32. Let's do some examples talking about the with recourse and the without recourse conditions. Clear this out. Okay. So first let's do with recourse. So you are sending these to somebody, I mean you're selling these off, but you're retaining the risk with these, so they could come back to you. So with recourse, so let's get some information. Let's say that we're going to factor out some receivables, and let's say that they have a carrying value equal to $200,000. Okay? And then let's say that when we factor these, we factor them for $160,000. Okay, I could give these, you could get like a percentage and you have to multiply and figure it out, but let's just say we know, okay, we're going to get $160,000 for these receivables. But it's on a with recourse basis. So when you have it on a recourse basis, you have to figure out something called recourse liability. And this is what you estimate might be uncollectible that you're still going to be liable for. Okay, so let's say that when we determine a recourse liability, it comes to $1,000. Seems kind of low to me, but you know. Okay, so we've got that information, and again, that's a fair value figure, or sometimes a present value figure, but we come up with, again, an estimate here, an estimated figure. So we want to figure out how to record this sale. Okay, so we got some money. That's the whole point of selling the receivables, and we got $160,000 in cash from the sale. All right. Now we know that we had this recourse liability, so this is something we want to record that might possibly, let me skip something because I don't know if I'm going to have a gain or loss. Okay, so let's put recourse liability down here. If we don't have to pay it, great. We can take it off later. But if we do, we've got to, you know, estimate how much we might have to pay. So we know that, and we know we got rid of these receivables. So we had accounts receivable that are no longer on our books. So we need to take them off. And that was our $200,000. So you tell me. Okay, what's missing here? We got 201 over here, we got 160 over here. So we got 160 for something that now is 201. Gain or loss? And again, you should always see that these have a loss. Loss on, I'm going to run out of, loss on sale of receivables. Going to run out of room. Sorry for the sloppy. And this comes to $41,000. Okay. Now, technically, you would, that's easy to see. I do that first, but how you would do this is you're going to make a comparison. All right, cash received, $160,000. Okay, less that recourse liability of $1,000. So really, you're talking about $159,000 in net proceeds for this sale. Okay, and when you compare that to the carrying value here is $200,000. That's going to tell you the amount of the gain or loss on sale. $41,000. Okay? All right, that's something with recourse. Okay, with recourse now. So, that was with recourse. Let's do one without recourse. So, you sell them, you factor them, you get rid of them, and if they don't get collected, well, it's not your problem. So, let's say that you're going to factor, let's do $200,000 of accounts receivable. And again, we're doing without recourse, okay? And we're going to transfer these to the factor company, and that factor company assesses, let's say they give us a 2% finance charge. And that's again on the amount of accounts receivable. And let's say that we're talking about, we're going to retain an amount equal to 3% of accounts receivable to cover things like sales discounts, returns, and allowances. Okay, so there's all the amounts we're talking about without recourse. Okay, and we're recording this as a sale. We're selling receivables. So let's record our journal entry for this. Well, first let's get some numbers. Well, this 2% finance charge, when you sell without recourse, that's going to be the amount of your loss, because that's the difference. It's not the difference in the cash, but that's the amount of the loss that you're going to have off the $200,000. The 3% is a retainage for, again, things like sales discounts and allowances, returns, so those types of issues. Okay, so that's going to change the cash amount, but this is the amount of the loss that you're going to suffer, is this 2%. So let's just get numbers. This 2% finance charge should come to $4,000, and the 3% that you're retaining is $6,000. Again, these are based on your account receivable relative to those percentages. So we know we've got cash. Let me show you how this works. Due from factor. This is the amount you're going to retain. Okay, because again, and think about this if you're confused. Let's say that you're selling off $200,000 of receivables, but really in there, let's say, let's make it more simple. Let's say you had a $10 receivable, and you're going to sell it to me, and I'm going to give you $8 for it. Okay, but what happens if there was actually, there was a discount tied to it? Well, then the amount we sold is really not the valid amount because there were discounts and returns and several other things in there. So that's kind of where this due from factor comes in. Okay, so due from factor, we've got, how much was that? Let's see, retain $6,000. So there we go. So let's record due from factor at the $6,000. And then also that finance charge, that is the amount of our loss. So loss on sale of receivables is the $4,000. So we determine this loss a little differently without recourse than with recourse. And then we know we're getting rid of $200,000 of receivables. Both of those come away from how much cash is paid to us from the factor. Okay, so this means that we've got a total of $190,000 that we're going to get in cash for the sale of these receivables.